We constantly guess what the future will look like, but we rarely ask how it will be funded. Let's run the numbers. What if a speculative transparency technology could completely eliminate information asymmetry from transactions? Under this assumption, both buyers and sellers would possess identical verified facts about the quality, origin, and actual cost of every traded asset. Nobody could conceal a defect or exaggerate value. We commonly expect that such absolute clarity would instantly make markets perfectly fair. If nobody can bluff, then transactions should become frictionless, efficient, and free from the traditional risk of fraud. Yet a deeper economic inquiry reveals a paradox. Eliminating the capability to strategically withhold information might actually destroy the incentive to trade in several of our most vital commercial institutions. In this scenario, perfect transparency does not optimize the pricing mechanism. Instead, it threatens to trigger market freeze-ups where participants refuse to negotiate because no surplus value remains to be captured. The fundamental mystery is why markets require a controlled level of information asymmetry to function at all. Let us explore the mechanics of negotiation surplus and the price discovery process. Consider the stakes. Negotiation is not just a battle of wits, it is the primary mechanism through which buyers and sellers establish value when there is no centralized preset price. Without the ability to strategically reveal or hide reservation prices, the negotiation process collapses. If both sides instantly know each other's walkaway point, no true bargaining can take place. If a buyer knows the seller's exact production cost, they will refuse to pay a single penny more. The seller, knowing they cannot extract any profit, will simply choose not to produce. Conversely, if the seller knows the buyer's maximum budget, they will demand that exact amount. The buyer, realizing they capture zero consumer surplus, has no incentive to purchase the item. This mutual awareness halts the exchange. Rather than creating a fairer deal, perfect information removes the economic surplus that makes voluntary trade mutually beneficial for both participating parties in the market. Markets would tend to freeze because the bargaining space shrinks to a single contested point. Without a zone of uncertainty, the cooperative surplus of trade cannot be divided between the parties. To analyze this scenario, we must first distinguish between different types of information in a transaction. Economists define information asymmetry as a situation where one party has more or better information. In standard economics, some asymmetry is considered a defect. For instance, a seller hiding a hidden mechanical flaw in a used vehicle is exploiting asymmetry to extract an unfair price. This is the classic market for lemons scenario. If buyers cannot distinguish high-quality goods from low-quality ones, they will only offer low prices, driving high-quality sellers completely out of the market. Interestingly, eliminating asymmetry for quality is highly beneficial. If buyers can verify quality instantly, trust returns, and high-quality trade can flourish without the fear of buying a hidden lemon. However, we must make a vital distinction between information about quality and information about valuation. Information about valuation is the private utility a buyer places on owning a specific good. My private valuation is not a defect. It is the personal preference that makes me value a product more than the money I must spend to acquire it from the merchant. If a speculative technology exposes both quality and private valuation, the pricing mechanism breaks down. When private preferences become public data, the room for voluntary price negotiation completely vanishes. It comes down to scarcity. The scarce resource is not the physical product, but the privacy required to negotiate. Without that privacy, price discovery becomes a zero-sum conflict. So, the seller, recognizing their weak bargaining position is fully exposed, may choose to withdraw from the market entirely to avoid being exploited, halting the transaction before it can even begin. Without that privacy, price discovery becomes a zero-sum conflict. Every trade becomes a battle over who can force the other party to accept a transaction that yields them zero surplus value. Consider how this affects commodity markets. In standard grain or metal exchanges, prices adjust dynamically based on aggregate supply and demand, rather than the private valuations of individual traders. In those centralized markets, information transparency is generally stabilizing. It prevents localized monopolies from charging inflated prices and allows capital to flow to where it is most urgently needed. But in decentralized, customized markets, the lack of information asymmetry creates a severe coordination problem. Think of real estate, specialized labor, corporate acquisitions, or unique intellectual property assets. In these customized markets, no two assets are identical and no public price list exists. Value must be discovered through active negotiation, which inherently relies on strategic disclosure. If a software engineer's exact minimum salary requirement is visible to every recruiter, the firm will never offer a dollar more. The engineer loses all opportunity to capture producer surplus. Over time, this dynamic suppresses the incentive for workers to invest in specialized skills. Why spend years training if the entire economic premium will be captured by the employer? Similarly, if an entrepreneur's exact acquisition target price is known, the purchasing corporation will offer exactly that figure. The incentive to build innovative startups begins to rapidly decay. Without the potential to capture a portion of the negotiation surplus, the economic return on search costs, diligence, and entrepreneurial risk-taking drops to near zero in the market. This decay leads to market thinness. When fewer participants are willing to enter negotiations, finding a trading partner becomes increasingly difficult, reducing the overall efficiency of the economy. Follow the incentive structure. Without the reward of finding a bargain, nobody pays the cost to search. Opacity protects the search and discovery efforts of all market participants. Now, when information is fully abundant, the premium shifts to institutional structures that can legally enforce fixed prices, bypassing the negotiation process entirely, which then change the equilibrium. If a platform eliminates all bargaining room, it forces a transition to administrative pricing. We see this in standardized gig work, where algorithms dictate wages without room for negotiation. Here is the constraint. Administrative pricing avoids haggling but cannot adapt to unique circumstances. It ignores the specialized skills, urgent timelines, or custom quality requirements of individual participants. One counterpoint to this analysis is that fixed-price retail markets commonly function highly efficiently without negotiation. Consumers buy groceries or electronics daily at set prices with zero bargaining. However, this fixed-price model faces a strict limitation in unique high-value asset classes. You cannot sell a custom corporate merger or a complex logistics network at a fixed retail price. For these customized transactions, the absence of negotiation room means the trade simply cannot occur. The fixed price mechanism is unable to capture the unique specific values of the parties. Under this assumption, we must separate standardized commodities from customized assets. Standardized goods benefit from transparency, while customized assets require a degree of information asymmetry to trade properly. Let us consider a hypothetical case of a specialized equipment manufacturer. In a perfectly transparent market, they cannot charge different prices to different buyers based on their specific utilities. As a result, they must charge a single uniform price. If this uniform price is too high for some and too low for others, total transaction volume in the market declines. Thus, the boundary of perfect transparency is reached when it begins to suppress market volume by forcing rigid, uniform pricing on complex transactions that naturally demand flexible negotiation. To resolve the opening mystery, we must recognize that information asymmetry is not always a market defect. In many cases, it is a structural necessity that enables the price discovery process. If a technology removes all asymmetry, it does not create a frictionless market. It simply forces a transition from flexible negotiation to rigid, administrative, or state-mandated pricing mechanisms. Interestingly, the collapse of negotiation markets would lead to the rise of massive centralized clearinghouses that dictate prices based on public algorithms rather than voluntary trade in the market. This centralized pricing regime would control moral hazard and adverse selection by force, but it would also eliminate the individual agency that defines a free, decentralized economic system. Participants would trade their bargaining power for transaction certainty. The The central algorithm effectively becomes the arbitrator of value, determining what goods may be produced and who receives them. If producers attempt to bypass this central system, they face immediate exclusion from the public data network, rendering their assets untradeable and forcing them back into compliance with the rules. Consequently, the hope that perfect transparency would democratize markets is structurally flawed. The economic reality of negotiation requires a zone of private valuation to remain completely viable under this assumption. So, the real engine of market exchange is not the public data feed, but the private search for surplus value that motivates individuals to trade with one another. The funding model decides what survives. Without a protected margin of private information, the market itself collapses into an administrative system. Pricing sets the ultimate limit of trade. When evaluating any new transparency policy or platform design, we must always look past the promises of absolute fairness and analyze the incentive structures in detail. We must ask who will retain the incentive to search for value when all private margins are fully exposed to the public domain in future markets. If a regulatory plan assumes that perfect information will automatically improve market outcomes, we must treat that claim with deep and measured economic skepticism. We must instead focus on designing institutions that protect the private incentive to discover prices under the changing conditions of standard market demand structure. This requires us to separate the moral appeal of complete openness from the economic mechanics of negotiation surplus and the price discovery process itself. The real danger is not the existence of private knowledge, but the institutional failure to reward those who invest in acquiring it in our commercial markets. By focusing on incentives, we can identify which market structures are sustainable and which will freeze under the pressure of perfect transparency in the future. The efficiency of future exchange will ultimately be decided by our ability to balance visible quality with private valuation in trade across different industries. We must analyze who controls the flow of transaction data to understand where future power will reside. The future is just incentives at scale. See you tomorrow.